Markets have been unusually nervous and volatile since late October, driven by fears of an escalating trade war with China, emerging weakness in European economies, tighter monetary policies from most major central banks, the post-election realities of a divided Congress, and a growing sense that the U.S. economy is struggling and/or possibly staring a recession in the face. I've called it global angst in my current favorite chart. See chart. Business investment is relatively weak, but corporate profits are at record levels. The housing market and residential construction have softened, but this is being at least partially offset by the recent 40 bps per second decline in mortgage rates. Today's jobs number was disappointing, but jobs growth this year still is stronger than it was last year. The Fed says it plans to raise short-term rates in gradual fashion, but the market has priced out two of the tightenings it expected earlier this month. The market now expects only one more tightening in the next 12 months, and no more after that. The yield curve has flattened in some areas, but remains positively sloped, and real short-term interest rates are still very low, only slightly above zero. Inflation expectations have fallen below the Fed's target, but this is almost entirely due to a recent sharp drop in oil prices. None of this points to recession. The problem is not the Fed, not deflation, or even low inflation, and not the yield curve. I think the main problem is a general angst that finds its strongest expression in the outlook for the US-China conflict. This creates uncertainty which acts as a headwind to growth and risk-taking in general. Regardless, we are besieged by worries of all sorts these days. What follows are 16 charts which help put things in a useful perspective. Chart. Note how real yields, blue line, remain in a gradual uptrend. This is a direct reflection of the market's perception that the U.S. economy remains healthy and is likely to continue growing at a 2.5 to 3% pace, in my estimation. Note also the recent decline in expected inflation. It's entirely due to the decline in nominal yields. No problems here. The blue line is the overnight real rate, and the red line is effectively the market's forecast for what the blue line is going to average over the next 5 years. The time to worry is when the blue line exceeds the red line. There's still a healthy spread between the two. But his chart? Swap spreads are also a good measure of financial market liquidity, and at today's levels, they continue to suggest that liquidity is abundant. That's very important, since liquid markets allow for market participants to exchange risk freely. Note how the sharp rise in swap spreads priced the Great Recession. They got so high that the market was almost paralyzed, and that contributed significantly to the meltdown of mortgage-backed and other risky securities. Liquid markets can deal with all sorts of problems, just as free markets maximize economic efficiency. The average household today has very strong financial fundamentals, and that is effectively a buffer against negative shocks. As the above chart shows, recent increases in household net worth are very much in line with the long-term, inflation-adjusted historical trend. This was not the case with the asset price bubble that occurred prior to the Great Recession, and prior to the 2001 recession, markets and households got overextended. Note also the tenfold increase in real net worth in the past 66 years. This is nothing short of breathtaking progress. Real estate values and debt levels have increased only modestly. In turn, as chart. It's not at all obvious that we are living in a bubble that threatens to pop. Chart. The current strength in the manufacturing sector points to very strong economic growth overall, at least 4% for the current quarter. That contrasts significantly from the modest 2.4% Q3 18th growth rate projected by the NY and Atlanta Fed's forecast models. Chart. That's not necessarily bad for the U.S., but it is another headwind to worry about. As with chart. 198K, but his chart 1 month's data is hardly significant. I prefer to look at the 6 and 12-month averages. Private sector jobs growth averaged 180K per month in 2017, and so far this year it has averaged 200K, that's an 11% improvement. Chart. Here we see the modest uptick in growth rates this year relative to last year. By these measures, private sector jobs currently are growing at a 1.8 to 1.9% rate, and that's only marginally less than the 2.0% average annual growth rate for the past 8 years. Chart. Today's 1.4% annual growth rate is substantially higher than 0.5% average growth rate we've seen since the economy bottomed in mid-2009. Chart. That's mostly due to an increase in the market's worries, as measured by the ratio of the VIX index to the 10-year Treasury yield, but it also reflects the fact that the economy has failed to accelerate as supply-siders, like me, had expected. Growth has picked up modestly in the past 2 years, but not as much as we would have liked to see considering how much deregulation and tax cutting there has been in the interim. China is the wild card these days, but it's also the case that for the next 2 years we're going to have a divided Congress that is unlikely to pursue a pro-growth agenda, and there are few signs, if any, that global growth is picking up. The market has priced in a lot of slowdown expectations. According to Bloomberg, the current P/E ratio of the today's equity premium, the difference between the earnings yield on stocks and the yield on 10-year treasuries, is 2.7%, and that's as high as we've seen since November 2014. This rather substantial repricing of equities is a potential positive, since it makes taking risk more attractive, and that in turn helps offset the de-risking forces of uncertainty emanating from places like China and Congress. Clouds and silver linings. The question confronting investors today is not whether the economy is going to slow down, that's priced in already. The question is whether it is going to slow down by a lot, and how certain one is of that future. In this regard, I remain optimistic that things won't be as bad as the market already fears. That's been my position for the past 10 years, actually, always thinking that the market was too pessimistic in its assumptions about the future.